Profit targets in depth. Let's have some fun with this. Managing winners is the cornerstone of tasty mechanics. We have traditionally closed our 45-day to expiration short premium winners at 50% of their max profit in order to increase our win rate and allow us to redeploy capital to new positions. Our recent experience in zero DTE markets has caused us to experiment with different target profiles, different target profit targets. We're going to investigate if 50% is really optimal, or should we consider, these are on longer trades, or should we consider adjusting our profit targets based on the initial features of the trade? You know, Tony and I like to use 21 DTE, but what do you want to use? Let's take a look and see what is truly optimal. So we used 15 years worth of SPY data. We sold 45 data expiration strangles each monthly expiration cycle at a variety of deltas. We consider the average P&L that would have been reached by managing winners at every conceivable profit target from 1 to 99%. We were looking for the most effective profit target to use based on strike selections. All trades were closed at 21 DTE.
Okay.
You good?
I'm good so far.
All right. That's where it gets a little bit chunkier. Let's go to the next slide. Okay. So
what am I looking at here?
Okay. So this is the average P&L for straddles. 50 deltas on both sides. And let me just see what this says.
It looks negative across the board.
Hold on.
Am I reading it right?
It's the mean.
Turn your head a little more.
Well, I'm trying to see. It's the first time that I've seen this particular slide, and so
first time with your new hands.
What we're looking at here is the first thing we're looking at is the average P&L for strangles. And you can, for straddles.
Right, so what's on the left? What's on the left-hand side?
That's the mean P&L per trade.
Okay, and the zero line, I made a mistake. The zero line is more towards the middle bottom of the graph, correct? About 1, 2, 3 higher, right? Yeah, I got it now. Thank you, guys.
Yeah. Made it a little easier to see. So you have the average P&L for straddles, and then you have there you go, and then you have the profit target percentage. Remember, we're going for kind of that, that 50% area. And then
well, 50%, no, you're looking at more of like a 10% here, right? 5 to 10% of the straddle. Otherwise, am I reading it right? Well, it looks like 30 is optimal, like right around 30.
Yeah. What this is going to show is that optimal profit target, well, I shouldn't say optimal, but the average P&L for straddles, if you put them on, sell the 50 delta call, 50 delta put, and you manage them at 21 DTE, you're going to come in somewhere just around, let's call it the 30 to 35% range. Okay. And
it looks like your risk is about 15%. Am I reading that correctly?
Yes.
So your risk is your profit to risk is almost 2 to 1 in your favor.
Yes. What it shows is with 15 years worth of data, when you put on a straddle, initially it's all over the place. Like you're always going to be losing a little bit at first, winning a little bit. Straddles are really hard to manage. But after a certain period of time, which in this case is up 21 days because we use 21 days across the board, the optimal area is in the mid 30s, let's just call it. Okay?
Okay.
Because remember, we're looking for profit targets. As we fast forward, let's go next slide. What happens here is as the deltas get a little bit smaller, profit target goes up. So instead of being in the mid 30s, it's in the low 40s now. Now we don't usually do 40 delta strangles, but you can see here with 40 delta strangles, even when they first start out for the first 10 or 20 days, your P&L is all over the place. You're going to have negative P&L. But then eventually it comes back to be positive and it kind of sits around there. And it doesn't make a lot of sense to hold it past the 21 days because it kind of flatlines after that. This is more towards the areas where we get to. So I think what the research team is trying to show you is that if you go to a smaller delta, like the 20 to 30, your profit target at that 21 days actually goes higher because you're collecting less money. So you collect less money, your profit target goes, your profit target goes up into that 50, 55 range. And after the 21 days, it kind of flatlines. But when you first put on a position, this shows you that the first 10, 20 days, it's all over the place. You're down money, you're up money, you're down money, you're up money, okay? And I think that this is actually a really good visual because it's showing you that as you reduce the deltas, you can go, your profit target goes up to the percentage that you want to make. These are all still at 21 days. Like the next one should be 20 deltas. And so this is kind of where we live in that 20 delta range. And what's interesting about this is the nice thing about 20 deltas is you don't have those drawdowns early on. You're not necessarily making money right away, but you're not drawing down like you are on the 50, 40, and 30 deltas. The 20 deltas tend to always kind of work your way because we usually don't go under those numbers. And then you maximize profits, at around 60+% at 21 DTE. That's why I like this. That's why I kind of like the 20 delta range. And then go to the next slide. And then here, this is the 16 delta. This one is less interesting to me. We usually don't get down to 16 delta, but they didn't draw the yellow line here, but it's the same thing. It's going to be up in the mid 60s. It's going to be a little higher than the 20 delta. And then it flatlines after that. And no drawdowns early on. If we go to the next slide, the takeaways. Very low profit targets make for frequent winners, but their effects on long-term P&L were erratic, and with small mechanic variations having large differences in results. So very high profit targets never triggered before reaching days to expiration management. So like trying to say you want to make 100% is unrealistic. Using profit targets slightly below the average 21 DTE P&L levels was able to consistently outperform and will be more time efficient than days to expiration management alone. So with strikes around the expected move, this made the 50% profit target close to optimal. Somewhat lower when trading close to at the money and somewhat higher when trading far out of the money. But the 50% averaged out to be pretty accurate, which we've been talking about all along.